Have you ever wished you could just travel back in time and get investing advice from a master right before one of the biggest bull markets in history kicked off? Well, today, that's exactly what we're going to do. We are deconstructing one single document, Warren Buffett's 1983 letter to shareholders, to pull out some principles that are frankly just as powerful today as they were back then. All right, let's get into it.
Okay, so I want you to really picture this. Forget your smartphone. Forget the internet. We are stepping into a totally different world. After years of economic pain and stagnation, there was this new feeling in the air. That brutal inflation from the 70s, it had finally been tamed. The stock market was waking up from this long hibernation. There's a real sense of optimism, a feeling that the worst is over and a new boom is just getting started. And this is where it gets really interesting. You'd think Buffett would be out there celebrating, right? Popping champagne? But nope. While the rest of the world was getting totally swept up in the rally, he sits down to write his annual letter. And what's he talking about? Not the roaring market, not some hot stock tip. He starts talking about business principles and his partnership with his shareholders. Think about that. Everyone else is watching the ticker tape, and he's looking at the foundation. That's a huge clue right there.
So what we're going to do is unpack the core lessons hidden inside this letter. Think of it like a roadmap to his brain at this really pivotal moment in history. We've already set the scene back in '83. So next, we're going to look at what he called the Berkshire Owner's Manual. Then we'll meet the incredible Mrs. B and find out what she taught him. After that, we'll uncover who Buffett called the pickpocket of enterprise. And finally, we'll boil it all down to one single golden rule that you can actually use today.
See, back in 1983, Berkshire's shareholder base was growing fast. So Buffett decided to lay out the rules of the game, crystal clear for anyone who owned a piece of his company. He literally wrote an owner's manual.
And this right here, this is the whole foundation. He wasn't just managing some faceless corporation. He felt like he was leading a partnership. He saw his shareholders not as speculators just trading his stock, but as true partners in the businesses he was building. And that isn't just fluffy language, it's a fundamental mindset shift that changes every single decision you make.
And boom, here are the rules. Number 1, think like an owner. The goal isn't just to get bigger, it's to increase the value of each individual share. 2, eat your own cooking. The managers have most of their own money right there in the stock alongside you. 3, reject leverage. They'd rather have a rock-solid balance sheet than chase every shiny object. And 4, be completely candid. They promise to tell shareholders the good, the bad, and the ugly. This isn't just some mission statement on a wall, this was a contract.
Now, the absolute high point of Buffett's 1983 was buying Nebraska Furniture Mart. And to get why this was such a big deal, you have to understand the force of nature behind it. Rose Blumkin, or as everyone knew her, Mrs. B. I mean, just look at this story. It's incredible. She escapes Russia, comes to America with nothing, can't speak English, scrapes together $500 to start a business. At one point, she was so dedicated, she sold her own furniture from her house to pay off creditors. By 1983, she'd built a single store doing over $100 million in sales, more than all her competitors in Omaha combined. And at 90 years old, she's still working the floor 7 days a week.
This is maybe the ultimate compliment from Warren Buffett. He's saying the competitive advantage she built was so powerful, so totally dominant, that trying to compete against her would be like fighting a grizzly bear. You're just not going to win.
And this is the whole point. The story of Mrs. B is the perfect real-world example of what Buffett calls economic goodwill. It wasn't the tables and chairs in her store that were so valuable. It was the intangible stuff, her reputation, her customer loyalty, the incredible brand she built from scratch. That's the real asset. The economic moat that lets a business earn fantastic returns. It's the magic ingredient he was always hunting for. So after laying out what a truly great business looks like, Buffett then turns his attention to the circus of the stock market itself. And let me tell you, he does not pull any punches. He starts with a question that even now goes against the grain. I mean, most CEOs love stock splits, right? They think it makes the stock more accessible. So why did Buffett absolutely refuse to do it? His reasoning is just pure behavioral psychology. He argued that a high stock price acts like a filter. It keeps away the people who are just looking for a quick trade, and it attracts people who are serious, long-term investors, the exact partners he was looking for. He was actively designing a shareholder base of rational, business-minded owners. And then he drops this absolute killer line. All this constant activity, this financial flip-flopping, as he called it doesn't make the factories run better. It doesn't help sell more products. It adds zero value to the actual business. All it does is drain money from the real owners. It's a pickpocket, just slowly and silently stealing from the enterprise. It's the same exact trap we see today with the gamification of trading. Every swipe, every trade, it feels like you're doing something, but really, you're just making the house richer. And to prove he wasn't just being poetic, he did the math. He actually calculated that based on the trading volume back then, investors were paying about $7.5 billion a year in frictional costs, commissions, and spreads. That was more than the combined 1982 profits of Exxon, GM, Mobil, and Texaco, the four biggest companies in America at the time. Just a staggering tax that investors were paying to themselves for no reason.
So after our little trip back to 1983, what's the one lesson we can pull out of all this and use right now? What's the golden rule?
It really all comes down to this one fundamental shift in your mindset. You're not buying a stock ticker that wiggles up and down on a screen. You are buying a small piece of a real, operating business, and you should treat that decision with the same seriousness as if you were buying the whole thing.
And that's it, right there, straight from the letter. Focus on the value of the business, not the price of the stock. Think like a partner, not a player. That was the absolute core of his philosophy in 1983, and you know what's amazing? It's still the core of his philosophy today. So the question this letter from 1983 leaves us with is a really simple one, but it's also incredibly profound. When you look at your own portfolio, when you think about your investments, just ask yourself, am I acting like a business owner, carefully choosing my partnerships for the long haul, or am I just a player in the market's game? As Buffett showed us all those years ago, the answer to that question makes all the difference.